If you checked your banking app right now and compared what landed in your account on payday to what you earned before deductions, you'd see the gap instantly. For most people in this country earning between £50,000 and £100,000, you effectively work from January through to May just to pay HMRC, 5 full months. Gone to the tax man. But the wealthiest people don't do this. They use a strategy that's completely legal, and yet almost nobody on a normal income has heard of it. It's called buy, borrow, die. In this, I'll explain how it works, why the system is tilted the way it is, and what you can start doing about it. Let's start with why you're probably losing. If you earn a salary here, the tax system is aimed straight at you. Income tax, national insurance, student loan repayments, most of it comes off before you see a penny. And once you get past the basic thresholds, the rates get harsh. Earn over £50,000, and you're paying 40% income tax. Over £125,000, it's 45%, plus national insurance on top. In certain brackets, effective rates can push past 50%. In real terms, if you earn £80,000 a year, which puts you in the top 5% of earners in the UK, you take home roughly £54,000 after tax and national insurance. That's about £26,000 gone every year. A meaningful amount. Money that could be a decent deposit on a flat in many parts of the country. And people earning 10 or 20 times that are often paying a lower effective rate than you. Not because they're doing anything illegal, but because they're not taking their money as a salary. That distinction matters more than almost anything else in the tax system. And there's another thing happening that gets far less attention, but may be costing you more than any single tax rise. Fiscal drag. Tax thresholds, the points where you enter higher bands, have been frozen since 2021, and they're staying frozen until at least 2028. That's 7 years. Inflation didn't freeze, so wages have risen a bit, but the cost of living has risen too. Each year, more of your income creeps into higher brackets, even when your real spending power isn't improving. The Office for Budget Responsibility estimated this will pull over 4 million extra people into higher tax bands by 2028. 4 million people paying more tax without a single rate changing. The government freezes the thresholds, and inflation quietly does the work. Clever if you're in the Treasury. Less clever if you're a teacher who got a cost of living pay rise, and half of it got swallowed by a bracket you weren't in last year. Now, follow the life of a single pound you earn, because once you see the full chain laid out, it's hard to ignore. You earn £1. Income tax and national insurance take their cut straight away, and you're down to about 60 pence. Then you spend it. VAT takes 20% on most purchases, so that 60 pence now buys you about 48 pence worth of stuff. Put fuel in the car and you pay fuel duty, then VAT on top of the duty. That's tax on tax. Not a metaphor, literally how it's structured. Save up and buy a house? Stamp duty, thousands just for completing a purchase. Sell an investment property later? Capital gains tax. Then you die, and it still isn't over. Inheritance tax takes 40% of your estate above the threshold on money that's already been taxed at stage after stage of your life. By the time that pound has traveled through the system across a lifetime, the government may have taken 70 pence, 80 pence, sometimes 90 pence of it. Nobody shows you the whole journey like that, because it reveals the reality. The UK tax system compounds against people who earn and spend normally. So that's the game if you play by the standard rules. Now here's what the wealthy do instead. And once you break it down, it's surprisingly simple. There are 3 big differences. First, they don't take large salaries. Most wealthy business owners pay themselves the minimum, often around the personal allowance of £12,570. That keeps them below the income tax threshold. Their company might generate millions, but their personal income on paper is close to nothing. Second, they move money into assets rather than pulling it out. Instead of extracting cash from a business and getting taxed on it, they use that money, or more often borrowed money, to buy things that rise in value: property, equities, other businesses, anything that grows while they do very little. Third, and this is the key, they don't sell. The moment you sell an asset, you create a taxable event. Capital gains kicks in. So instead of selling, they borrow against the value of what they own. They access wealth without triggering tax at all. These ideas aren't complex. They're just not part of the conversation most people are having about money. And that gap in awareness is where the divide between the wealthy and everyone else begins. So let's put it together. Buy, borrow, die. Stage 1. Buy. You acquire assets that appreciate over time. Property is the classic UK example, but it could be shares, commercial property, any kind of real estate, or a business. And typically you buy with leverage, a mortgage, a loan. You use the bank's money to control an asset without liquidating your own capital. Stage 2. Borrow. This is where it all comes together. As your assets rise in value, you borrow against that growth. That's refinancing. And the critical point is simple. A loan is not income. You do not pay income tax on borrowed money. Here's an example. You buy a property for £200,000 with a £150,000 mortgage. Over 10 years, it rises to £400,000. You refinance at 75% of the new value, giving you a new mortgage of £300,000. You pay off the original £150,000, and you've released £150,000 into your hand. No sale, no capital gains event, no income tax, because it's debt, not income. Then you take that £150,000 and repeat. Buy another asset, let it appreciate, refinance, repeat. Each cycle the pot grows. The tax bill stays at 0. Stage 3. Die. Blunt but unavoidable. And this is where the strategy completes. When you die, your assets pass to your heirs. The debt attached to those assets reduces their value for inheritance tax purposes. And with proper structuring, trusts, family investment companies, business property relief, the tax on that transfer can be significantly reduced and in some cases removed entirely. So you spend your life accessing wealth through borrowing, never selling, never triggering capital gains. Then the assets transfer in a way that minimizes inheritance tax. That's the strategy. Simple and legal. And this isn't just theory. It's standard practice at the top, and the examples are well documented. When Elon bought Twitter, he didn't sell his Tesla shares. Selling would have triggered a huge capital gains bill. Instead, he borrowed against his Tesla holdings, billions in loans secured against stock he didn't sell. Tax on those loans is nothing. Jeff Bezos ran Amazon for years on a salary of around $80,000, while being worth over $100 billion. His wealth sat in shares. When he needed cash, he borrowed against them. Closer to home, Adele, worth over £200 million, bought a £50 million house and took out a mortgage. She could have paid cash, but paying cash means liquidating assets, which can trigger capital gains. A mortgage costs a few percent in interest. Selling assets could cost 20% or 40% in CGT. The maths is straightforward. You and I aren't buying £50 million houses, but the principle works at every level. A landlord with 2 properties in Leeds is using the same mechanics as Elon Musk. Buy an asset, let it grow, borrow against the growth, don't sell. Different numbers, identical system. So the obvious question is, how does a normal person start applying any of this? First, if you run a business or you're self-employed, you likely need a specialist accountant, not a generalist. Someone who truly understands extraction strategies, structuring, and tax planning. The difference between an average accountant and a great one can be tens of thousands a year, and that's why people at the top pay for specialized professionals. Second, think in assets, not just income. Put every decision through a simple filter. Does this pay me once, or does this build something that keeps growing? A salary pays you once. An asset compounds. Third, separate good debt from bad debt. Consumer debt, credit cards, car finance, buy now, pay later, get rid of it. But debt attached to an appreciating asset, where someone else is servicing the repayments, like a tenant covering your mortgage, is different. That isn't just a liability, it can be a tool. Fourth, start now. It doesn't matter whether you're 22 or 52. Understanding how wealth is built is something most people never get around to. The fact you're engaging with this already puts you ahead of most. And I'll finish with this, plainly. The UK tax system isn't broken. It's working exactly as it was designed to. It was designed to tax labor, salaries, wages, people who trade time for money. And it does that extremely efficiently. What it doesn't do, by design, is tax wealth in the same way. The wealthy buy assets, borrow against them, and pass them on. They don't sell. They don't create taxable events. They aren't bending the rules. They're using the rules as they exist. I'm not telling you to dodge tax. I pay my taxes. I'm happy to contribute to the NHS, schools, and the things we all rely on. I'm saying don't pay more than you're legally required to, because the people with the most money in this country certainly don't. Buy, borrow, die isn't just a strategy. It's a way of thinking about money most people are never taught. And once you understand it, a lot more of how the system works starts to make sense.